27th, Saturday, and I'm just going to go ahead and review the markets and lay out some projections for you guys. It's my first video, so I'm going to go ahead and talk about some fundamentals on how I approach sort of making predictions on the market and fundamental understanding of basic things such as bonds, such as the stock market in general, and then specific plays, and of course futures and how to hedge in a decent way. So, real quick, like most traders, the way I like to approach the markets is I look at major indices like the S&P 500, which is the largest holding of collectively the best companies from the United States. You can see in this heat map, you have it broken down lovely in a lovely way into information tech, communication services, consumer discretionary, banks, and so forth, right? As we saw this past week, we had some major earnings announcements like Google and Microsoft. They totally smashed earnings, which is why they rallied significantly. They gapped up overnight, Thursday night into Friday, and uplifted the market overall. But I think personally, I'm a little skeptical. I don't think this rally is going to continue for much longer this week, especially because we have Apple and Amazon reporting earnings this coming week. And we also have a big Fed funds meeting, which is going to be critical. And the reason why I say it's going to be critical is because right now, what we saw, this recent contraction down to the 50 moving average almost, the 100-day moving average on the S&P, I largely attribute it to, just general profit taking after like a 6-month continuous rally. Shout out to Bob Johnson in our War Room chat. But largely, personally, I believe it's because of the bond market. So something that I also like to do, aside from approaching the S&P, is look at the Dow Jones. Look at the Dow Jones. Look at the Russell 2000. Look at the Nasdaq. Okay, and then see how they're doing overall. See their sectors, and then pick out individual weaknesses in stocks, and try to go long with them if they have a good outlook overall, right? Or play alternative plays, which I'm going to get to. But overall, right now, if you look at the market, bonds have been falling hardcore, and we're almost at that level, momentum driven, to that level that we were back in October when we had that trough in bonds, and therefore also a trough in the overall general market like the S&P 500, the Dow Jones, and the Russell 2000, right? And then we saw a beautiful, like, massive rally since November, October, into essentially what was like January, right? Basically right now actually. And now we're finally seeing this contraction, this sell-off, right? And so when you have bonds falling, it's because interest rates are rising because there's a lot of instability and these large institutional investors such as Ray Dalio's Bridgewater Capital, BlackRock, a lot of these big institutions that hold a lot of capital, a lot of retirement funds, and a lot of even endowments for big universities. They're reshuffling investments to more stable assets such as bonds, and they're selling off their current holdings of bonds because it is in their best interest to pick up the new bonds because they have higher interest rates, better payouts, the Federal Reserve rates, the Federal Treasury rates, and of course, like junk bonds in general. They fluctuate constantly whenever new companies issue them and whenever, of course, the Treasury issues new bonds. So when bond prices are dropping, that means interest rates are rising, of course, that's simultaneously. And therefore, when you have massive momentum driven things in the bonds market, like we're seeing right now, where we're just about, two major handles away on the 10-year note, which is forward/Z on Thinkorswim. And for the 30-year note, which largely correlates to your fixed mortgage rates, you can see that we're only just a few handles off as well. And that's a scary situation to be in because if this continues falling, oh man, it's not going to be good for the overall market. It really isn't. You're going to be seeing more of a contraction. That's just what I foresee happening. And I've seen through sort of my trading experience. Now, to talk about the general market, right? Let me pull up some expected moves real quick too. Something that I like to use is this is made by a trader that I consider one of my gurus, Don Kaufman from TheoTrade. He created this, his team, they made this beautifully laid out sort of study tool for Thinkorswim called the expected moves, where it's driven off of 1 week implied volatility on the options market for the S&P 500. You can see that basically depicts a 1 standard deviation move, and we can see that it broke out of the expected move range for the 1 standard deviation to the upside because of just some beautiful earnings coming into play from major stocks, and of course perhaps even a bounce back from just what was could be considered a bit of an overselling last week. The week prior, and we saw a little bit of a bounce back. But personally, I don't see this lasting too long. Maybe we see a little bit more of a rally, but personally, I think that if we do, we're probably going to see some stagnation and some downfall, probably ultimately. Just based on how the bonds are performing, and of course the strength of the dollar increasing. If you type in dollar symbol DXY, you can pull up the US dollar, how it's doing overall in comparison to many other currencies, and you can see on the US dollar as well, we're back at that level that we were at, that top in October, which is when we saw one of the lowest points of the market last year. Horrible time, people didn't know what to do. A lot of funds are buying more stock. Some were selling off, putting on and hedging, selling S&P futures at the time, delta hedging. And so we saw a beautiful rally, but right now we're seeing a sell-off, and it might just reciprocate the sell-off that we saw back then as well. Personally, I think that we are going to definitely see that for the next couple of months, and I could be wrong. This is just a prediction, and what I hope to do is foster maybe a bit of a learning environment and some feedback from you guys, whoever watches this and comments and asks questions moving forward, on how these things play out, right? And so we saw it on the S&P that it broke out of the expected move. We saw that similarly on the Russell 2000, it rallied a little bit, broke out of the expected move range. But overall, that's kind of how I approach the market. I look at a top-down perspective on how all these guys are performing. The S&P 500, we can see largely it's just your major tech stocks that have done fantastic, but then banks are falling. A lot of healthcare stocks are falling, like Johnson & Johnson bailed out of that trade. I'll talk about it in a little bit. Energy was falling a little bit, selling off. But due to geopolitical tensions, overall, oil is still on an upwards trend. You can see that it fell down. Let me remove these Fibonacci levels real quick. Fell down, sell off, people were taking profits. Tensions seemed to be stabilizing, but then the war broke out between, not really a war, but Iran had launched those drone strikes in Israel. We saw oil spike up, but then it fell right back down because tension stabilized. Iran tried to play it off. When they did that, Israel shot down all their rockets, but then Israel did retaliate. Oil prices were shooting up a little bit again. And I mean, overall, it was on an upwards trend already. We can see gas prices throughout the United States, pretty dang expensive right now. And so just overall projections wise, the way I see the market going is, again, sideways stagnation. So if you go ahead and look at some portfolio trades that I've put on right now, I'm the biggest thing I'm long on right now, organizing by Netlink, is Nike. It's just like more of a value stock listed in more so classical funds like Vanguard, just different retirement type funds to build over time, just basic value stocks. They're kind of not doing too hot right now due to interest rates, but if you look at the overall trajectory of Nike over the past several years, kind of a long-term, short-term play, I guess. I'm hoping for a bit of a swing on this. I'm a swing trader overall. Not the best, definitely looking to learn and get better, but maybe you guys will take away some pearls from this. Let me remove that study real quick. Remove all studies. You can see Nike. This might be a pick for some of you guys. Just overall, past several years, when it gets this low, usually it does a pretty good job at bouncing back reliably. So the trades that I put on in this particular stock is I'm long on 95 shares. I was long on 100, 105 eventually, but then I started dollar cost averaging down. I'm in at 90.75 overall, just driving liquidity into my account. Another big holding is TQQQ. So a good way I see to play out this situation is to just slowly wisely pick in dollar cost averaging moves, look for key retracements off the expected moves, off of your Fibonacci levels if you're into that sort of thing, and of course your moving averages. Personally, I don't think that we're going to see a full bull rally unless it breaks past the 50-day moving average. We saw it retract all the way down on the daily, right? Even below its 100-day moving average. So momentum-wise, it was definitely slowing down, but then it bounced back very nicely, right? And so the reason why I think that this week is going to be extremely critical is because you have large stocks that are big holdings in both the S&P and NASDAQ combined, things like Apple and Amazon reporting this week, right? And Apple, as we know, is lagging behind because people are skeptical about it. They seem to be lagging behind on the AI race. Their iPhone sales are slowing down, especially in China. due to economic tensions and a lot of microchip manufacturing shifting out of China and Taiwan back into the United States. We have the CHIPS Act that was recently, passed. I think just like last year, 2 years back, $50 billion. A lot of it's going to Intel actually, but also to fund companies like TSM to move domestically to the United States to start manufacturing their chips, and so on. So a little bit of an unexpected movement in Apple. We've seen it go down. It's hit this flat line over here, this resistance support level, 168, whatever you want to call it, 168 to 170. It's been consolidating ever since. But truthfully, I can see it going either way. So Top G in our chat was also saying he thinks it's consolidating. A lot of people are kind of expecting a bounce towards the upside as we saw in the market, but I'm just a little skeptical. So the way I'm playing it out, again, is like I'm trying to, I'm a fan of leverage ETFs. I just get a little bored of the movement on regular things like SPY and QQQ. I just try to play leverage for that case. Dollar cost averaging TQQ, and then of course your hottest stocks right now, which are your chip stocks. SOXL is a good leverage play, driven off the SOX, of course. It bounced up nicely. I'm dollar cost average somewhere around the level it's at right now, unfortunately. I've been kind of buying on its way down and buying back on its way up. Just at different levels I think are pretty decent. And again, it could be wrong. Just trying to keep that to maybe like 1/3 of my account, 2/5 of my account. And then just picking something that I think is doing well, or it's going to do well, is Nike, just from a stochastic viewpoint. They're laying off workers like a lot of other companies, so I do think they're poised for a bounce back. But real quick, to talk about the Fed's meeting coming up this week, just to give you guys a general understanding of how things usually play out. I think I have it pulled up over here already. Here. So if you just search up Fed Funds tool, first let's pull up the CME Watch tool, right? So as of right now, majority of the market believes that 97.6 of basically the Wall Street in general, big institutional funds, they foresee rate cuts not happening this meeting on May 1st, this coming week. June, vast majority still think it's going to stay stagnant at 5.25 to 5.5%. July, vast majority still the same way. It's really not until September that you see majority of people, even then it's kind of slight, thinking that we might get at least one rate cut, okay? By November, majority of people definitely think that we're going to get 1 to 2 rate cuts. December, same thing, right? And this stuff really fluctuates over time, right? You can kind of trace things out over here, how the market feels about where it's going to end in 2025. By 2025 start, where is our federal fund rate going to sit, right? But for now, it's more so that a lot of people just overall truly do believe that we're going to probably sit stagnant at 5.25 to 5.5%, pricing in maybe one rate cut. And the way to analyze that and compare it to what the Fed puts out in terms of what their trajectory is, they publish this every time. Fed funds trajectory projection, right? If you just search that up, you can see here. Let me go back actually over here. If you pull up the Federal Reserve projection publications, sorry, the phone goes off in my house a lot. Okay. Here, transcripts and other historical material, or is it meeting calendars information? If you go to projection materials right over here, you can pull up the PDF and you'll see that they put out a dot plot, right? So every dot is one Federal Reserve board member on their board when they meet every, whatever scheduled meetings they have. And they, every once in a while, every 2 meetings, pretty much 2 to 3 meetings, they put out a projection for where they see the Fed funds rate going by the end of the year, right? So you can see the most dots correspond to this level right here, 4.5 to 4.75, meaning we're going to get a total cut of about 0.5 to 0.75 basis points by 2025, majority of people. So one of my buddies and I, we did a deep study on this to see overall how does it compare by the end of the year. We looked back and compared to where the Fed funds rate sits to how the trajectories look at the start of the year for that prior year. Usually they cut down to 0.25 to 0.5% above whatever their trajectory originally was. That's just how it's been kind of consistently. So overall, personally, I think we're probably going to see one rate cut of 25 basis points, maybe 2 if we get lucky by the end of the year, down to 4.75 to 5%. But realistically, I think we're probably just going to see one rate cut of 25 to 50 basis points down to 5 to 5.25%. Excuse me. Uh, Maybe even less than that. Maybe we don't get any rate cuts at all. Now, if that's going to keep the markets flat, I don't think so necessarily. But just overall, right now, there's a lot of tension in the market, and there's no denying that. Okay, people use this as a good chance to sell off, take some profits, buy back in. But we might see some more sideways action into the foreseeable future for at least another, for what in my opinion is another couple of weeks to months. So just dollar cost average. Don't let this opportunity go to miss out on key entry levels on stocks, but also don't, what I it's, maybe I shouldn't say that I recommend because I'm not a certified financial analyst or anything like that. This is not investing advice. But personally, the way I'm playing it is I'm trying to just DCA on its way down and just, being careful about it. But again, I don't recommend anything. Follow your own due diligence, talk to your own financial advisors. I am not a financial advisor. I'm just an amateur. So, for what it's worth, I think a lot of people nowadays, in our millennial group and Gen Z as well, we like to learn about this stuff now, how to make a little bit of money on the side. So just be careful. You know what I mean? Don't put everything into one thing and just kind of dollar cost average your way down on a lot of these different things. But here's some other plays for you guys if you're interested. I like to play the triple leverage on Bitcoin. It's in a volatility box right now. If you pull this up here, let's pull up BITO. Okay, I don't want to pull up the futures because then it doesn't go for that far back because they expire. But let me remove these moving averages. Actually, no, I'll keep them up. So you can see it's below overall pretty much everything. The only thing holding up at this point is the 100-day moving average. It's in a bit of a volatility box right now. Let me draw that real quick. Okay, here we go. It's in a bit of a volatility box right now. Personally, I do see it breaking out towards the upside. I'm just a Bitcoin kind of, I'm a just Bitcoin enthusiast kind of person. So I do hope and see it going toward the upside. We had that halving recently. It didn't crash as some people were expecting it to, which is good. It's nice. Definitely holding up the support levels around, I think this is like 60K, 62K. It dipped down all the way to, and then it bounced back nicely back to 66, 67K. You can pull up the Bitcoin futures to see that. MBT, right? That's the micro. So you can see it bounced up to 67K. Then it fell back down, fell down to low to 63. I think after hours right now during this weekend, it's down to 62K, something like that. But overall, it's in a volatility box. There's no denying that. It's just kind of pinging up and down, not really knowing where to go. Being supported by the 50 down to 100-day moving average. Hasn't touched that, luckily. But maybe this 50 support holds and it breaks above your 20 to 26 day, 20 days simple moving average to 26 day. This is 26 days exponential. This is your 20 days simple moving average. And if that's the case, you're probably going to see a bit of a rally. Now, whether that's going to be aggressive or not, I don't know. But definitely Bitcoin can serve as I think what we're seeing is it can serve as an alternative investment, like a safe investment. I'm also long on, you can see just a small position in gold. That's doing kind of okay. I have a call spread laid out for May, 212.5 by 215 strike, call spread, 240 call. FXI is an interesting play I have. This is a bit of a alternative play as well on the Chinese large caps. They're starting to bounce back nicely. You can see over the past several years, the Chinese economy, a lot of those large cap stocks in their country domestically over there have been doing kind of poorly, but the CCP is driving liquidity into the market. They are buying and trying to stabilize the market for investors to encourage them to stay or whatever reason it is. And we're seeing this bit of a breakout. We're seeing that on Alibaba. We're seeing that BYD, Warren Buffett's company that he's invested in over there, the number one competitor to Tesla. They sell more cars than Tesla, actually. Stock, but I picked up a protective put just in case it does retract. What was it? IFX. I don't even know what I just pulled up. IXF. No, it was, what was it? Wow, FXI. Wow, drawing a blank here. Didn't get enough sleep. Okay, so if it retracts back down, I'm probably going to buy more of this stock. Otherwise, I have a protective put temporarily put on for a retracement if it doesn't continue to break out. Otherwise, I definitely am more on the positive delta side in this trade. It's a very, very liquid index you can trade that when it breaks out beautifully, and the options are priced extremely cheap. You can get a protective put on for the 24 strike for just $30. And so that's just another interesting trade if you guys are looking for alternative investments. BITO, of course, got a call spread on that, pretty safe. The numbers are just kind of jacked up right now because of the fact that it's after hours. Those options prices jump all over the place. I'm long on Intel. I think it was oversold. They beat earnings, but they just have a poor projection outlook because they've been putting so much money into their foundry in Ohio, and they're trying to catch up in the AI race to everybody else. Like they're significantly behind Nvidia and I'd say even AMD actually in that part. Um, I think it's an interesting play as well. If you were kind of like a contrarian to me, I don't think it's going to continue downfalling too hard. Hopefully, definitely not to that 25.6 support level. I think that maybe it bounces back a little bit. I think that it was just overblown how badly people were collectively just pooping on the stock and shitting all over it. SiriusXM, of course, Warren Buffett's involved in this one. It's a merger between SiriusXM and Liberty Media for the Formula One stuff that's going on right now in the country. It's pretty awesome. Big fan. I do see them breaking out, hopefully within the next month. Ulta, just another value stock makeup company, kind of similar to SD Lauder. I was long with SD Lauder for several months. Took my profits on that, put it into Ulta now. They had that earnings, and you can see in the past they usually dip hard as hell, but then they usually bounce back, and it's at a nice fib level of 411 right now. Maybe it falls down to this trend line you can see over the past several years. Maybe it falls lower. I think it's worth the risk. The risk reward ratio is definitely there. I think it's worth it. Next earnings report's coming up at the end of May, so hopefully we can get up before then, before that IV crush happens post earnings. And we'll talk about that in future videos. I'm long on Snap-on, which also has a nice post for a nice bounce back. You can see it's holding up. Well, this is the weekly chart. On the daily, it looks kind of disgusting, but maybe it bounces back. I think it's worth the risk reward ratio on this one as well. Small plays throughout is the name of the game right now. Long on Netflix, just one call, cheap call, down $22, not a big deal. They recently fell post earnings because of the fact that they changed. Although they did well on earnings, they've just changed how they report things. Definitely the 100-day moving average is holding up for it. I think that it is going to continue maybe consolidating, hopefully bounce back towards the upside. I definitely don't want to. You definitely don't want to miss out on the tech gains if I'm wrong and the market does bounce significantly. So play at your own discretion, right? Do your own due diligence. If you have a financial advisor, talk to them. If you have friends, this is not financial advice. I'm just spewing what I like to do right now, and hopefully people can gain from this. And then Nike, of course, and I'm hedging my whole portfolio through VIX futures, right? It's about $2,000 a contract. When SPY falls, this rises. Okay, more volatility, put call ratio, this is going to jump, right? $2,000 SPY contract, but if it bounces up, it's like you get $1 for every 0.01 that it moves, right? So to hedge your portfolio, I mean, hey, you can make a 25% return on this thing if the market falls down a lot more. Save your portfolio a little bit here and there, buy 2-3 VIX contracts. If it's just one idea, don't, again, not recommending, but, if you're interested, go for it, right? But hope this is helpful for you guys watching, and I hope to continue onwards in the future making videos and market recaps, and hopefully people can gain from this. But again, just overall projections, maybe I can draw them out. Maybe that'll be helpful too. Overall projections, maybe the market goes up, maybe it goes sideways, maybe it goes down. Personally, I'm more of this opinion. These two right here is probably going to go sideways, maybe rally a little bit, but overall probably downwards projection. Okay, so good luck to you guys. Hope to see you in the next video. Thanks.